Money is usually presented as a subject of numbers. People study interest rates, investment returns, debt, inflation, and retirement calculations as if financial success depends mainly on understanding the correct formulas. But real life tells a different story. Some highly educated financial professionals lose everything, while ordinary people with modest salaries quietly build enormous wealth. Morgan Housel opens The Psychology of Money with two men who demonstrate why this happens. Ronald Reed spent most of his life working as a gas station attendant and janitor. He lived simply, saved consistently, and invested in established companies. When he passed away, people discovered that he had accumulated more than $8 million. Richard Fuscone followed the opposite path. He received an elite education, became a successful executive at Merrill Lynch, and earned millions. He retired early, lived in an enormous home, and appeared to understand money at the highest possible level. But Fuscone spent heavily, borrowed too much, and built a lifestyle that could not survive a major financial setback. After the 2008 financial crisis, he declared bankruptcy. Reed had almost no formal financial training, yet he became wealthy. Fuscone possessed deep financial knowledge, yet he lost everything. The difference was not intelligence, it was behavior. Financial success depends on patience, humility, discipline, and the ability to manage fear, greed, and social pressure. A person can understand every financial formula and still make terrible decisions when emotions take control. That is the central message of The Psychology of Money. Doing well with money is not mainly about what you know, it is about how you behave. Blink 1. Everyone sees money through a different personal history. People often look at someone else's financial choices and wonder how that person could behave so irrationally. One person keeps nearly all his savings in cash even though inflation slowly reduces its value. Another invests aggressively and seems unconcerned when markets fall. Someone refuses to borrow money, while someone else is comfortable carrying a large mortgage. From the outside, some of these choices may look foolish, but Housel argues that people do not make financial decisions using facts alone. They make them through the lens of their own experiences. Someone who grew up during the Great Depression may spend the rest of his life fearing unemployment and poverty. A person whose family lost its home may never feel comfortable with debt. Someone who began investing during a long bull market may believe that stocks almost always recover quickly. These beliefs are not created by spreadsheets. They are shaped by memory. People also experience only a tiny part of financial history. A person may live for 80 years, but the modern financial system has passed through many different periods: depressions, wars, inflation, falling interest rates, economic booms, and market crashes. Each person sees only a small portion of that history and then uses it to form a broad view of how money works. This explains why intelligent people can examine the same information and reach completely different conclusions. They are not only looking at numbers, they are interpreting those numbers through different life experiences. This should make us less judgmental of other people and less certain about ourselves. What feels like an obvious financial truth may simply be the lesson produced by the particular period in which we happen to live. Understanding this limitation prepares us for another uncomfortable reality. Even when people make good decisions, the final result is never fully under their control. Blink 2. Luck and risk influence every outcome. Success stories usually emphasize talent, effort, and intelligence. Failure stories usually emphasize poor judgment, laziness, or incompetence. But these explanations often ignore two invisible forces: luck and risk. Housel uses the early life of Bill Gates as an example. Gates was clearly intelligent, ambitious, and hard-working, but he also attended Lakeside School, one of the few schools in the world that gave students access to a computer during the late 1960s. At a time when most university students had never used one, Gates was able to spend thousands of hours learning how computers worked. That opportunity played an important role in the creation of Microsoft. This does not mean Gates succeeded only because he was lucky. Many people could have received the same opportunity without building one of the world's most valuable companies. His ability and determination mattered enormously. but the opportunity itself was still outside his control. Gates had a close friend named Kent Evans, who shared his interest in business and technology. Gates later suggested that Evans might have helped him build Microsoft. But Evans died in a mountaineering accident before finishing high school. Two talented young people stood near the beginning of promising careers. One experienced an extraordinary opportunity. The other experienced an unlikely tragedy. Luck and risk are closely connected because both describe events that influence life beyond the power of individual effort. This makes extreme success and extreme failure difficult to study. We may copy every decision made by a billionaire without knowing which results came from skill and which came from fortunate timing. We may condemn a failed entrepreneur even though an unpredictable event caused the failure. The more extreme the outcome, the more cautiously we should interpret it. Instead of copying one exceptional person, Housel recommends focusing on broader patterns that appear repeatedly. Work hard, save consistently, remain patient, avoid decisions that can destroy you. These lessons are more dependable because they do not require extraordinary luck. Recognizing luck should also make successful people more humble. Recognizing risk should make us more compassionate when other people fail. And because the future will always contain events beyond our control, financial success must begin with something more important than maximizing returns. It must begin with survival. Blink 3. Getting wealthy and staying wealthy require different skills. Building wealth usually requires optimism. You must believe that the future can improve. You must accept uncertainty, invest before every question has been answered, and take risks that may not work. Keeping wealth requires a different mindset. It demands caution, humility, and constant awareness that success can disappear. Many people are skilled at making money but fail at preserving it. Early success increases their confidence. Confidence encourages them to borrow more, concentrate their investments, or take larger risks. Eventually, one mistake destroys everything. Housel describes investor Jesse Livermore, who made an enormous fortune during the stock market crash of 1929. While millions of people were losing money, Livermore became extraordinarily wealthy. But he continued taking large risks, eventually lost his fortune, and ended his life in tragedy. His story shows why survival must be treated as a financial strategy. A temporary loss can be recovered. A person who is completely wiped out loses the ability to participate in future opportunities. This is why Housel values room for error. Keeping cash, avoiding excessive debt, and diversifying investments may reduce potential returns during good years. But these precautions help you remain standing during bad years. And remaining in the game gives compounding time to work. A sensible financial mindset, therefore, combines two ideas that may seem contradictory. Be optimistic about the long-term future. People continue to create businesses, solve problems, and improve productivity. Over long periods, progress is a reasonable expectation. But remain cautious about the path between today and that future. Recessions, market crashes, wars, job losses, and personal emergencies will happen. Long-term optimism and short-term caution can exist at the same time. The goal is not to avoid every risk. Without risk, meaningful financial progress may be impossible. The goal is to avoid the risk that can permanently remove you from the game. This matters because the greatest financial results do not usually come from one brilliant decision. They come from giving a good decision enough time to grow. Blink 4. Compounding needs time, patience, and endurance. Warren Buffett is one of the greatest investors in history, but his investment skill alone does not explain the size of his fortune. Buffett began investing as a child and continued for more than 7 decades. At the time Housel wrote the book, the overwhelming majority of Buffett's wealth had been accumulated after his 65th birthday. If Buffett had earned the same annual returns but started investing in his 30s and retired in his 60s, he would still have become wealthy. But he would not have accumulated anything close to his actual fortune. His greatest advantage was time. Compounding is difficult to understand intuitively because the human mind expects growth to happen in a straight line, but compounding grows on top of previous growth. This means the biggest gains often arrive near the end of a very long period. In the early years, progress can feel disappointingly slow. That is why so many people interrupt it. They chase strategies that recently performed well, sell during downturns, or take excessive risks because they want faster results. But a moderate return maintained for several decades can produce more wealth than an exceptional return that lasts only a few years. The best strategy is therefore not always the one offering the highest possible annual return. It is the one you can continue following through recessions, crashes, and long periods when nothing exciting appears to be happening. Compounding does not require constant brilliance. It requires endurance. The same principle explains why a small number of successful investments can create most of a portfolio's long-term return. In business, investing, and creative work, results are rarely distributed evenly. A venture capital firm may invest in dozens of companies. Most will fail or produce ordinary returns, while one exceptional company generates nearly all the profit. A film studio may release hundreds of movies, but a handful of franchises create most of its long-term value. An investor can also be wrong many times and still succeed if the winners are allowed to grow. The problem is that people often do the opposite. They sell successful investments quickly to protect a small profit, while holding unsuccessful investments because selling would force them to admit they were wrong. This limits the upside of winners while preserving the downside of losers. Financial success does not require perfection. It requires staying active long enough for a few good decisions to become extremely valuable. But even this patience becomes difficult when comparison pushes people to believe that whatever they have is never enough. Blink 5. The most dangerous financial game has no finish line. Money can improve life, but the pursuit of more has no natural ending. A person earning an average salary may envy someone earning $500,000. That person may compare himself with someone earning $10 million. The millionaire may compare himself with a billionaire. Every achievement creates a new comparison. At a gathering hosted by a wealthy hedge fund manager, author Kurt Vonnegut told his friend Joseph Heller that their host had earned more money in a single day than Heller had earned from his famous novel Catch-22. Heller replied that he possessed something the host might never have: enough. Knowing you have enough does not mean rejecting ambition or refusing to improve your life. It means recognizing when the pursuit of additional money requires risking something far more valuable than the possible reward. Housel discusses Rajat Gupta, who rose from modest beginnings to become the head of McKinsey and serve on the boards of major companies. Gupta had wealth, respect, and influence. But he wanted more. He became involved in insider trading, was convicted, and went to prison. He risked his freedom, reputation, and legacy, despite already possessing more money than he could reasonably need. The danger of endless comparison is that the finish line keeps moving. No amount of success can satisfy someone whose definition of enough always depends on another person. This pressure also explains why people spend money to display success. Housel calls this the man in the car paradox. Imagine seeing someone driving an extremely expensive sports car. You may admire the car, but you probably spend very little time admiring the driver. Instead, you imagine how people might admire you if you owned that car. The driver may have purchased it partly to gain respect, while the people watching are mostly thinking about themselves. What many people truly want is not the car, watch, or large house. They want admiration. But expensive possessions rarely create the level of respect people expect. Kindness, reliability, and humility usually create more genuine admiration than visible luxury. This leads to one of the most important distinctions in the book. Being rich is visible. Wealth is hidden. A rich person may have a high income and expensive possessions. Wealth consists of the money that has not been spent, savings, investments, and financial assets that provide future choices. When someone buys a $100,000 car, the only thing we know with certainty is that the person now has $100,000 less than before. The car may have been purchased with savings, debt, or borrowed money. The appearance tells us almost nothing about financial security. True wealth is invisible. It is the luxury purchase that was declined, the salary increase that was invested, and the lifestyle that did not expand every time income rose. And the purpose of preserving that wealth is not simply to watch a number grow. Its real value is the freedom it can buy. Blink 6. The highest return money provides is control over time. People often measure financial success through income, possessions, or net worth. Housel offers a different measure. The greatest value of money is the ability to decide what you do, when you do it, where you do it, and with whom you do it. Money creates freedom when it allows you to leave a job you hate, care for your family, move to a new city, or wait for a better opportunity. You do not need to become extremely wealthy before experiencing this benefit. A modest amount of savings may allow someone to reject an unreasonable employer. A larger reserve may provide time to change careers or start a business without demanding immediate success. This flexibility has enormous psychological value because having control over life is strongly connected with happiness. A prestigious job may offer a high salary, but if every hour belongs to someone else, the personal cost can still be severe. Modern knowledge workers may appear to have comfortable jobs, yet their work follows them everywhere. They think about unfinished tasks during dinner, check messages late at night, and worry about deadlines during weekends. Their bodies have left the office, but their minds remain there. Money is valuable when it creates distance between your life and demands you did not choose. That is why saving matters even without a specific goal. Traditional financial advice often says to save for a house, retirement, education, or a holiday. But Housel argues that saving can be useful even when you do not know exactly how the money will eventually be used. The future will contain both opportunities and problems that cannot be predicted. You may lose a job, discover a new career, face a family emergency, or receive an opportunity that requires quick action. Savings give you options. This becomes especially important in a world where industries change quickly and skills can become outdated. A person with no savings may be forced to accept the first available job. A person with financial reserves can wait, retrain, or choose a more promising direction. Saving also depends on more than income. Some people earn modest salaries and steadily build wealth. Others earn enormous incomes but save nothing because their lifestyles expand just as quickly. Housel describes saving as the gap between income and ego. The less money you require to impress other people, the easier it becomes to build independence. You cannot control market returns or economic growth, but you have much more control over how quickly your lifestyle expands and how much of your income remains available for the future. The point of saving is not to deny yourself every pleasure. It is to create a life in which one unexpected event does not remove all your choices. Blink 7. A reasonable plan is better than a perfect one. Financial models search for the mathematically optimal decision. But people are not machines. A portfolio may appear perfect in a spreadsheet and still fail if the investor becomes frightened and abandons it during the first major decline. That is why Housel recommends being reasonable rather than perfectly rational. A rational investor might keep almost no cash because stocks offer higher expected long-term returns. A reasonable investor may hold more cash because the security helps him sleep and prevents panic selling during a crisis. A financial model may suggest keeping a low-interest mortgage while investing additional money. But someone may prefer paying off the home because living without debt creates peace of mind. That choice may not maximize theoretical returns, but it can still improve the person's life. The best strategy is the one you can continue following. A slightly imperfect plan maintained for 30 years will usually produce better results than an optimized plan abandoned after 2 difficult years. This also means that financial advice must match the game you are playing. A day trader may buy a stock because he expects its price to rise within hours. A long-term investor may buy the same stock because she believes the company will grow for 20 years. Both decisions may be reasonable, but the people are playing completely different games. Problems begin when one person copies the other. A long-term investor sees short-term traders making fast profits and begins chasing price momentum. A conservative retiree copies an aggressive young investor who can afford large losses. Someone saving for a home follows advice intended for money that will not be needed for decades. An action can be correct for one person and disastrous for another. Before following any financial advice, you need to know your own time horizon, goals, and tolerance for loss. Personal finance is personal. The right plan is not the one that looks most impressive to someone else. It is the one that matches your values, survives your emotions, and remains sustainable. And because no plan will unfold exactly as expected, it must also leave space for the future to surprise you. Blink 8. Room for error is more valuable than precise forecasting. People usually build financial plans around what they expect to happen. They estimate future income, expenses, investment returns, and retirement needs, then organize their lives as if those estimates will be approximately correct. But the future rarely follows a precise forecast. Room for error is the distance between what you expect and what you can survive if the expectation is wrong. A person may expect an investment portfolio to produce strong long-term returns, but build a retirement plan that still works with lower returns. A household may qualify for a large mortgage but purchase a smaller home so that one lost income does not create a crisis. A company may expect stable revenue but maintain enough cash to survive a prolonged decline. These buffers can appear inefficient during good times. Cash earns less than stocks. Insurance costs money. Diversification prevents an investor from placing everything into the best-performing asset. But efficiency becomes dangerous when it removes every layer of protection. A bridge is not designed to hold only the exact amount of weight engineers expect it to carry. It is given additional strength because forecasts and conditions are imperfect. Financial lives deserve the same protection. Debt and leverage require particular caution because they can turn a temporary problem into permanent ruin. An unleveraged investor may wait for prices to recover. A heavily indebted investor may be forced to sell at the worst possible moment. This is also why financial history cannot provide a perfect map of the future. The events that changed the world most dramatically were often surprises. Depressions, wars, financial crises, technological breakthroughs, and global pandemics. These events mattered precisely because they were not widely predicted. The future will also be shaped by developments absent from today's forecasts. History remains useful, but the lessons should become more general as we look farther back. Specific predictions about which industry will perform best or where interest rates will move are fragile. Broader lessons about greed, fear, incentives, and risk are more durable. Technology changes quickly. Human behavior changes much more slowly. We should use history to understand what people are capable of, not to pretend we know exactly what happens next. Because the future is uncertain, every rewarding strategy comes with a cost. The key is deciding whether we are willing to pay it. Blink 9. The price of long-term success is uncertainty. Everything valuable has a price, but the price of investing is not clearly displayed. The cost of long-term market returns is volatility, uncertainty, fear, and regret. Stock markets have created enormous wealth over long periods, but investors did not receive those returns for free. They endured recessions, crashes, and years when their portfolios appeared to move backward. Many people want the reward without paying the emotional price. They attempt to sell before every decline and return before every recovery. They search for experts who promise to remove uncertainty. But successful market timing requires two correct decisions: knowing when to leave and knowing when to return. Very few people can do this repeatedly. Housel suggests viewing volatility as a fee rather than a fine. A fine means you did something wrong. A fee is the cost of receiving something valuable. When a diversified portfolio falls, the decline does not necessarily mean the strategy has failed. It may simply be part of the price required for long-term growth. This does not mean every falling investment will recover. It means there is no strategy that offers high returns, complete stability, and perfect certainty at the same time. Pessimism makes this emotional cost feel even heavier. Bad news attracts attention because negative events happen quickly. A market can crash in a day. A company can fail within months. A war can destroy years of progress almost immediately. Improvement usually occurs more slowly. Economic growth, medical progress, and compounding unfold across decades. Because the progress is gradual, people adapt to it and stop noticing. There are many overnight tragedies, but few overnight miracles. Optimism does not mean believing nothing bad will happen. Crises, recessions, and failures are unavoidable. It means recognizing that problems create incentives for people to respond. Shortages encourage new production. High prices attract competition. Disease encourages research. Difficult conditions force companies and individuals to adapt. A person can be cautious about the next year while remaining optimistic about the next 20. That combination, short-term caution and long-term optimism, captures the philosophy of the entire book. Financial success is not built through perfect predictions. It is built through behavior that can survive an unpredictable world. Save consistently, even when you do not know exactly what the savings will be used for. Control your lifestyle so that higher income produces greater freedom rather than greater pressure. Give investments enough time to compound. Recognize the role of luck when you succeed and the role of risk when other people fail. Build room for error into every important plan. Avoid risks that can permanently remove you from the game. Do not copy people pursuing different goals, and do not measure your success through possessions bought to impress strangers. Ronald Read did not become wealthy by predicting the future or discovering a secret investment formula. He spent less than he earned, invested the difference, and allowed time to do most of the work. Richard Fuscone possessed far greater financial knowledge, but knowledge could not protect him from debt, excessive spending, and overconfidence. Their stories reveal why money is not simply a test of intelligence. It is a test of patience when progress feels slow, humility when success arrives, discipline when comparison creates temptation, and endurance when the future becomes frightening. You do not need to make perfect financial decisions. You need to make reasonable decisions that you can repeat for a very long time. Because the greatest purpose of money is not to create the appearance of a successful life. It is to give you control over your time, protect you from unexpected events, and allow you to build a life that truly belongs to you. Summary of the main points of the book. The Psychology of Money argues that financial success depends more on behavior than intelligence. People make decisions based on personal experience, while luck and risk influence outcomes more than most of us admit. The most reliable approach is to save consistently, avoid excessive debt, leave room for error, and allow compounding enough time to work. Wealth is not what people can see. It is the money that remains available to give you choices and control over your time. You do not need a perfect strategy. You need a reasonable plan that you can continue following through both good and difficult periods.